Hey, good morning, Joe.
Good morning.
Good to talk to you again. We've got a presentation, so I'm going to let you sort of tell people a bit about the fund first, please, and then we can get to some questions.
Okay, sure. Good morning, everybody. AVI Global Trust is about £1.1 billion of assets. It's a global investment trust. Trades at about a 10-11% discount currently, which is somewhat narrower than it's been over the last 2 or 3 years. Somewhat wider, beg your pardon. And the objective of the trust really is to achieve capital growth through investing in a portfolio of companies trading at discounts to net asset value. AVI has been running this since 1985. And I've been with AVI since 2002 and have been the lead manager since 2015.
Joe, we've lost you, have we?
I'm here.
Sorry. Okay.
You want to keep going through the presentation?
Yes, please. Yeah. Good. Sorry.
Sure. Okay, so over that time, we have delivered strong annualized performance, 11.5% a year since I took over in 2015. And over the very long term, almost 40 years, just under that 11.5%. We do something different to what most other trusts do. It is focused on a universe of companies that, as I say, trade at discounts to net asset value. And essentially, the focus of our investment activities and the universe is on areas of the stock market that are perhaps neglected and overlooked by other investors, and that gives rise to the inefficiency and the undervaluation. A key part of what we're trying to do here is to engage with management, with the boards of these companies where we see an undervaluation, and to try and encourage them, or in some cases pressurize them, to adopt measures or policies that will narrow the discount and deliver value for all shareholders. Importantly, what we do is unconstrained. It's entirely benchmark agnostic, and the portfolio is built entirely on bottom-up fundamentals. And also, it's worth noting that the portfolio is quite concentrated. The top 10 holdings make up around 55% of the NAV, and there are maybe 20 to 25 core holdings within the portfolio. So we want to have a portfolio that looks very different to the benchmark, but also a portfolio that is highly concentrated and that has not only the undervaluation story, but that has the potential for some shareholder engagement and activism to help deliver those returns. We're a team of 12 investment professionals that has grown over the last few years, but we are based predominantly in London. We've got one colleague based in Tokyo, and I've been working with Tom, the head of research, for 12 years now. And there's been a lot of experience on the team. We've had our financial year at the end of September, so we've reviewed that here. You can see that it's been a good year for us relative to both the MSCI World and the MSCI World ex-US indices. And that's really come about from positioning the portfolio to benefit from a number of idiosyncratic events and high conviction in the portfolio. It was really, if we look back over the past 12 months, it was a tale of two halves. The first half culminated with a very sharp sell-off during March of 2023, which eroded a lot of our performance, a lot of our outperformance, and left us substantially behind indices at the halfway mark. But we've recovered that quite strongly over the second half of the year, as markets have been a little bit stronger and we have delivered respectable outperformance. It's really come about from a sharp recovery in some of the biggest fallers in the first half of the year, and we stuck with them and added to them at lower prices, but also by positioning the portfolio to benefit from some of the idiosyncratic corporate events that were occurring at some of our larger positions. We highlight here Spectrum, Schibsted, and FEMSA, and we can talk about those in greater detail. So you see here the scale of the share price performance from some of our biggest contributors. Apollo and FEMSA notably very, very high 70% and 90% increases over the year. Apollo and KKR in particular were detractors in the first half of the year. So you can see the benefit of that high conviction, high research driven approach that allows us to remain invested and add to positions that we've got a lot of conviction in. There were some, as there always are, some detractors. The scale of the share price returns here are a lot more muted than the contributors, and I guess that's what helps contribute to our performance. But a number of these, not all of them, but a number of these, Wacom, ACCA, and IAC, were positions that we added to marginally over the course of the year. So it's been a year in which investors have been focused on persistent inflation, up until recently at least, the chances of interest rates remaining higher for longer, and the impact that has had on risk assets, coupled with the fact that along with higher interest rates, investors are able to earn, superficially at least, attractive interest rates of return by not taking any risk, by buying short-dated government bonds. And so it's been a sluggish year and a worrying year for equity markets. But despite that, we feel that it's quite an attractive environment for us. It's one in which, with risk now being priced by investors, the opportunity for careful stock selection, for positioning the portfolio to benefit from idiosyncratic events, by pushing for events via activism or engagement. It's a much more fertile hunting ground for investors such as ourselves than it has been over the past decade or so. And I think that's reflected in the performance over the year. And it's still a very attractive opportunity set for us. And we are seeing opportunities really across the board. Listeners who have followed AVI Global for a while will know that we tend to focus on certain types of companies trading at discounts to net asset value. It includes family-controlled holding companies around the world. It includes Japanese cash-rich small-cap companies, and also opportunities within the investment trust sector. And today we're seeing wide discounts to good quality assets on attractive valuations really across the range of our universe. And on average, when you look at the portfolio weighted average discount today, it's approaching the 40% level that tends really to be a line in the sand. We rarely go much beyond 40%. We did occasionally for a very short period of time during the COVID sell-off, but that was no more than a week or two. So 37, 38% discount is attractive for us. And on top of that, investors in AG today also benefit from the wider than average discount that our shares are trading at today, around 10.5%, 11%. Gearing is an important point to highlight here. It's worth saying that in general, I don't favor market timing. I don't favor holding large amounts of cash if we have good opportunities to invest in. I think market timing is a futile exercise for most investors. We do have the ability to adjust the gearing levels to reflect concerns over the market or excitement about the opportunity set. It's fairly small fry, I would say, but it was interesting nevertheless to note that throughout 2022, from the end of 2021, as markets were looking quite expensive and as we started to enter the sell-off environment, we weren't utilizing any of our gearing. But coming into 2023, we felt that we were seeing an increase in the number of attractive opportunities, and then have been utilizing the gearing for much of the year. We have around 12 to 15% gearing capacity. It's in a mix of different currencies. We've got some euro, dollar, and yen, and sterling long dated debt facilities. We also have some short dated yen facilities, and actually in the last year we also raised some 10-year money in yen. So we've got a range of facilities in different currencies that helps provide a natural hedge to our portfolio, which is globally diversified. And a lot of that was taken out at very attractive interest rates, certainly compared to where we are today. So geographically, the portfolio on a look-through basis, you can see here on the slide, it's, I would say, a little bit overweight Europe. It's relatively underweight North America, certainly when you compare it to the world index, and it's overweight Japan, where we see a lot of opportunities. But the point to highlight here is that we are benchmark agnostic, and regardless of whatever benchmark you compare us to, it won't really change how the portfolio is built and what the portfolio is exposed to. This is entirely bottom up. And alongside this, you can also see our exposure to different types of opportunities. We've broken out the different holding companies between Europe, North America, South America, and Asia, and also the closed-end fund sector. So you can see a marginal increase in closed-end funds over the year. There's been some shift in allocations there. We've reduced European holding companies in favor of North American holding companies, and the other areas have remained broadly the same. I've mentioned how we've tilted the portfolio towards some of the idiosyncratic events. I've highlighted things like Schibsted and FEMSA. So you can see here some of the changes in the portfolio, the biggest changes in the portfolio over the year. We've added to Princess and Pantheon in the listed private equity sector. We've recently taken a larger stake in Hypnosis on the back of events there. We've made Schibsted our largest position on the back of events that were occurring there, and initiated a couple of new positions, News Corp being one, and a handful of Japanese regional banks as well. To fund those, we've taken money out of Pershing Square and Exor, to a lesser extent out of Christian Dior. All of these remain portfolio positions. All of them remain attractive investment opportunities, we think. But given the events that are occurring in other places and the relative attractiveness, we felt it's worth taking some money out of those existing positions and redeploying it in higher conviction ideas. There were 3 full exits during the year. Spectrum Brands had an event that led to a re-rating of the share price. And for us, that was the reason we were invested in it in the first place. We took all of our money out. Eurazeo was one that had similarities with other companies in the portfolio, so we took our money out of that and deployed it elsewhere. And Fujitec was a successful investment activist campaign in Japan. It'd been a 5-year investment for us, and we took our profits out of that.
Cool. Should we stop there rather than go into the detail of the?
Yeah, absolutely.
And then we can, because I can see questions coming through already on individual positions, so we'll go to them. So let's start with go back to the big picture thing first. So you said that you're index agnostic, and it's all idiosyncratic. So can you just sort of confirm that there's nothing really changed in the way that you ran the money in response to what happened with the shift in inflation and interest rates? Is that true?
That's absolutely true. No change at all.
Fair enough. That's a nice, quick and easy one. So, a more general question. Can you talk a little bit about engagement and how you go about doing it, and what's the sort of normal response you get?
Yeah. So this very much depends upon the kind of situation, but there are a few basic principles. The first point to make about our engagement is we're very comfortable engaging with boards, with managers. We want to have a dialogue, and we want to help companies address the problem of a discount, of an undervaluation. And that leads us to wanting to be, in the first place, relatively constructive. in that dialogue. We're not out to beat up boards. We're not out to publicly embarrass or shame boards and managers. We want to have a constructive dialogue. And all of that really is borne out by the idea that when we see a discount, when we see a company trading at a discount, we don't just buy a pound of assets at 70 or 80p because we think that the quicker that we can monetize that discount, we get our money back, and that's great. What we really want to invest in, and what I think the portfolio reflects, is a pound of assets that is growing in value over time. And that means that if we can buy a good value company that's going to deliver outperformance in terms of NAV growth over time, and we can buy that on a discount, and we can have some impact on an event to narrow that discount, then we can generate very strong returns. But the idea about being focused on good quality businesses, it means that we have time, we can be patient, we can be supportive. And that really informs our engagement with boards. We're not in a rush to monetize that pound before it starts falling in value. We can be patient about unlocking that value, but we want to push boards to do something to deliver returns. Now, in some cases, we can be the largest shareholder and we can be in the driving seat. In other cases, a family will be the largest shareholder and they'll do what they want. And so therefore, our engagement can't force them to change their minds, can't force them to do something they don't want to do. And it's much more about aligning our interests. And then in some situations, and you've seen that with hypnosis recently, it could become a little bit more vocal, it could become more public, and it could seek to protect the interests of minority shareholders much more explicitly than in other examples.
Yeah, that's cool. So, I mean, constructive is, I think, is the key thing, isn't it, really?
Yeah, absolutely. That's what sets us apart from perhaps the, I don't know, more aggressive hedge fund type activism that you see from some.
That we won't name here. Yeah. All right, cool. So we've got quite big increases here in Princess and Pantheon. So, and we've got a couple of questions around private equity. So do you want to, I know I got a slide here. Can you talk a little bit about what the attraction of the private equity sector is, please?
Yeah. So we started increasing our exposure a little more than a year ago, I would say, to listed private equity, which along with the falls in the market had suffered share price declines, suffered widening discounts, and some decreases in NAVs as well. And we felt that a lot of that reflected a perception by investors that what we were about to go through in terms of the market correction would mirror what we saw in the financial crisis in 2008 and 9. And thinking that there would be a replay of that situation, investors panicked. They sold all the listed private equity trusts, thinking that NAVs would collapse, that private equity investors would struggle to meet their commitments, that they were stretched, their balance sheets were stretched, and they were doomed to go back to 50% discounts, as well as sharp declines in share prices. And looking through that, we felt that that was an overreaction. First of all, portfolio exposure in terms of the types of companies and the types of leverage that those deals were founded on were very different to where we were during the financial crisis. We also, so we had a lot more stable cash flow generating businesses that were still growing, generating good earnings growth and valued on much more reasonable valuations than we've seen previously. We also saw evidence from the secondary market where transactions were taking place of private equity portfolios much closer to NAV than were being priced in by the listed private equity market. So we felt that on a selective basis, there were signs of an overreaction. And on top of that, when you have that kind of environment, you have forced sellers, you have panicked sellers, and it was an opportunity for us to find blocks and to get exposure to situations where we thought that investors were overreacting, and we were able to buy them on a very wide discount to what we thought was very realistic NAVs. And then coupled with that, you have a situation in a number of cases where there's some kind of corporate angle, there's some kind of engagement angle, We've seen with Pantheon the response to the opening discount in terms of the tender offer and the share buyback, and those are kind of things that we would have been saying to the board and encouraging them to do. And the more we see of that, the better. But again, it's a reflection also that boards see what we saw, and that share prices have overreacted and discounts are too wide.
There's a more specific question here around the private equity valuation. So what gave you comfort that the valuations were correct?
So it depends on every situation. Some funds have got more direct portfolios, some funds are more fund of fund type portfolios. But the information transparency is quite good from many of these private equity funds. You can break the portfolio down into different components. In terms of small, mid cap, large cap, in terms of the types of businesses they're exposed to, types of sectors they're exposed to. You can look at the earnings growth that these companies collectively are generating. You can look at the kind of multiples they're valued at and compare that to where listed market multiples are trading at. And then in some situations, specifically Oakley Capital, then you've got a lot of transparency on a direct portfolio, and you can actually value a lot of the assets, not all of them, but a lot of the assets in there, and form a view as to what the true market value of those things are. So depending upon the situation, there's a lot of number crunching and a lot of analysis that you can do that has given us a lot of comfort in the valuations. Now, sometimes we will take a haircut to that, and sometimes our valuation will be different to that of the reported NAV, but nonetheless, we still think we're buying them on a very wide discount.
Do you have a sort of preference for funds like Oakley that are investing in all their own funds on a relatively concentrated portfolio versus like a Harbourvest or a Pantheon with a very diversified fund? Or what do you think?
I would say that on balance, a situation like Oakley, where you have a much more concentrated portfolio, where you are able to do the analysis on a number of the larger holdings, and you can draw some conviction from that, is a more natural long-term investment for us than something like Harbourvest or Pantheon, which is very, very diversified. It's a fund of funds. You have exposure to hundreds, if not thousands, of different companies in there, and it's much more of a sector play than a specific attractive opportunity.
Yeah, fair enough. That makes sense. Good. There's a specific question about Exor. I'm not sure if there's a. Do you want to sort of talk through what the attraction of Exor is? And I know you've reduced the position, but
Exor has been a long-standing investment for us. It's the holding company of the Agnelli family, and it has stakes in 3 or 4 large listed companies, notably Ferrari, the luxury sports car company, Stellantis, which is the merged entity of Fiat Chrysler and Peugeot, which also owns the Jeep SUV business in the US, and CNH, the agricultural trucks and tractor company. Alongside that, they had a stake in Partners Reinsurance. They owned 100% of that, so that was an unlisted business which they sold in the last year and got a lot of cash back from that. And they've also got some small investments in things like The Economist and some luxury goods brands as well. So the thing we like about it really is the quality of those underlying assets, their valuation. Just to highlight, for example, Stellantis trades at something like 1.5 times earnings, whereas its peers in the US trade at 5 or 6 times. It's listed in America. It's not part of the S&P passive index trackers, and that's one reason behind its undervaluation. So we see a lot of undervaluation in the portfolio. We see good capital allocation decisions from management and the family behind that. It's got a long-term track record that far exceeds returns on the world index. it's trading at a very high discount, both in absolute terms of 45%, 43%, and relative to its history. And we've seen that the family have made good allocation decisions. They've sold assets well, they've bought assets well, recently buying a stake in Philips, which is going through some challenges. The reason why we reduced it, notwithstanding everything I've just said, is just we needed to find capital from some existing names to redeploy or divert to more immediate situations where we thought that in the forthcoming 6 to 12 months there was likely to be something happening, whereas Exor is more of a slow burn, giving us exposure to good companies, but probably the events are unlikely to occur in the very, very near term.
Okay, thank you. Next one to focus on is Brookfield. I think we can get a sense of why it's slightly different, because it's in here in the holdings here, but it's also down here as a hedge. So do you want to talk us through how that position works, please?
Yeah, so we own a stake in Brookfield Corporation, which is the holding company of the whole Brookfield Group. They had a restructuring about 12 to 18 months ago, in which they sought to create this holdings structure in order to provide greater transparency on the group and the valuation. It's fair to say that it hasn't worked particularly well as yet, in that it's trading at a 40% odd discount. But essentially what you have is Brookfield Corporation is a holding company. It owns stakes in these things that you can see here on the slide. Brookfield Asset Management, they own a 75% stake in, which is the broader asset management group. And it also owns stakes in some listed closed-end funds and some real estate. We've created a structure here where we've limited our exposure to the unlisted assets, principally the real estate. And we've also limited our exposure to benefit as the discount narrows. We think the discount is unduly wide. We think, and so the reason we've structured it this way is really a couple of reasons. On the discount front and on the absolute share price, we think that management are very focused, very incentivized to get the discount down and get the share price up. It's not been an easy environment for that to happen, but the whole restructuring and reorganization of the group is designed to do that. And as markets settle down, we think that they'll work on that to a greater extent. So by limiting our downside to discount widening, we think we've got an attractive risk-reward profile here. Also, with regards to the real estate, your listeners will be well aware that there's been a lot of noise around just how bad and how badly affected the commercial real estate market has been in the US in particular. This portfolio does have exposure to the US as well as other markets. But the way we've structured this, and given the price at the moment, we are buying into this on a massively negative value. So I think if we were to write down the carrying, we're paying a negative value for the real estate, which we think is very, very attractive and unlikely to materialize to that extent.
Okay, thank you. Now then, back to the holding page. Just a quickie, can you explain the difference between Christian Dior and LVMH, please?
Yeah, sure. So Christian Dior is the holding company above LVMH, and it's the holding company through which Bernard Arnault and his family own much of their stake in LVMH. So the family owns just under 98% of Christian Dior, which is listed on the French Stock Exchange. Christian Dior, in turn, owns around about 48% of LVMH, and that's all it has in it. So by buying Christian Dior on a 16% discount to the value of its stake in LVMH, we think we're getting an attractive discount to investors who are buying LVMH directly in the market.
Okay, that makes sense. Thank you. Schibsted, we should talk to next, because I think it's the biggest holding. So can you just talk us through the rationale for this one, please?
Yeah, so Schibsted, very briefly, is a Norwegian listed company operating in the online classifieds ads businesses. So it's got a broad European online classifieds business, which are businesses which are unlisted. And then it's also got, so it's got Nordic ones, which are unlisted, and then it's got Adevinta, which is more broadly geographically spread. Adevinta is a listed company. The rest are unlisted. Now, its share price has suffered over the last couple of years. It's fallen a long way. And we became attracted to this because when you subtract the value of the Adevinta stake from the market cap of the company, it left us paying a very low multiple for the attractive online classifieds as businesses that were not listed, that Schibsted owned, in particular the Nordic ones. Something like 6 times currently, whereas online classified businesses are trading at much higher multiples, of well into the double digits. Now, one of the reasons why this undervaluation existed was because Adevinta share price had been weak. Online classifieds businesses were seen as being economically sensitive, and so investors were panicking out of that. But also, really, why this exists to the extent that it does is because the whole balance sheet, whereby you had some unlisted businesses and you had the stake in Adevinta, creates some complexity that investors aren't very good at seeing through, and that distorts the superficial high-level valuation picture and really creates an opportunity for us. And moreover, the reason why we've been adding to it substantially over the last year is that we felt that management were becoming concerned about the undervaluation and were conducting a strategic review to analyze courses of action that they could pursue in order to address that undervaluation. And a lot of that focused on the stake in Adevinta, whether Schibsted should keep that stake in Adevinta or whether something should happen with it. And interestingly, over the last month, there's been confirmation that Permira and Blackstone, two private equity investors, have made a bid to acquire a large stake in Adevinta. We'll see whether it's the entirety or a controlling stake or not. And that has led to a sharp increase in the share price of Adevinta, as well as a sharp increase in the price of Schibsted, as investors have begun to anticipate a large return of capital to Schibsted from the sale of their stake in Adevinta, and have started to think about what that could mean for capital allocation with Schibsted and what that could mean in the share price. So it's something that's a live situation. The undervaluation has improved in a sense over the last 4 to 6 weeks as we've had news of the transaction, but we're still waiting for clarification and confirmation as to the exact level and the extent of that bid. And that will then hopefully push the share price higher and correct that undervaluation to a greater extent.
Great, thank you. Now, Apollo and KKR.
Yeah.
How much of the value of Apollo and KKR is made up of the funds that they're invested in, as opposed to the sort of valuation of their asset management businesses?
It depends. Each one is different, but you're right to highlight the fact that for us, the attraction and the reason why we've chosen to invest in Apollo and KKR rather than some of their competitors such as Blackstone and Ares is because they do have substantial balance sheet assets, and those balance sheet assets make up a significant chunk of the market cap of the company, leaving the implied valuation for the contracted earnings streams from the funds business at pretty low levels.
Okay, fair enough. How good is the governance of those companies, do you think?
I think the governance is good. I think I've got no reason to doubt the governance. There's very, very powerful alignment of interest between management and outside shareholders through share incentive schemes that will very, very lucratively and generously reward the management of both of these companies on top of their existing ownership of shares if they're able to get the share price up to higher levels. So I think there is powerful alignment of interest here.
Okay, thank you. Now, part of the thing, I suppose, a lot of the funds are kind of alternatives, aren't they? Here in the UK, we've got a lot of alternatives in our sector, and they're trading at quite big discounts. Have you been attracted to some of those, like the infrastructure funds, the renewable funds? Have you been sort of having a look at those?
Within AGT, we haven't yet done anything in those alternative sectors, but we have been looking at the sector, and I share your perspective on it. Yeah, discounts are wide, and I think in some cases there are some attractive assets there.
Okay, great, thank you. We need to talk about hypnosis. So I think the question actually is just says, what's the next step? So do you want to sort of set the scene a bit and then talk about what you think is going to happen now?
Yeah, look, if you go back a bit in time, we had a stake in Hypnosis. We sold out probably 3/4 of that stake a couple of years ago, and we're left with a small rump position that we held as it continued to fall in price and fall in value. It was only really in the last couple of months that we rebuilt the position to an even greater extent and made it a very substantial investment for us. And we did that on the back of a series of events which started with a takeover of Roundhill Music, its competitor, at a very substantial premium to its prevailing share price, and at a relatively smallish discount to its reported NAV. And that started to spark our interest in Hypnosis. It seemed to demonstrate that Hypnosis was trading very, very cheaply, and now with a transaction occurring in the sector, we felt that Hypnosis would be under pressure to do something to help re-rate their shares. As you know, Hypnosis announced a partial sale of its portfolio, roughly 20%, I think, and that was done at a wider discount than where Roundhill came at a superficial level, and certainly very much wider than the transaction that Roundhill took place at, when you started to account for add-on fees and costs, etc. And that really concerned us. And it concerned us even more because the buyer was a buyer who was a related party. Blackstone has a relationship with the manager, has a right of first refusal, which effectively meant that other bidders were completely disincentivized from submitting a bid and doing the due diligence, because it would mean that Blackstone would just have an option on that. So bringing all of that together, we felt that Hypnosis was extremely undervalued. We felt the board hadn't done a particularly good job. We felt that there were a lot of conflicts of interest, and we, together with other shareholders, worked hard to make that known to the market, and we argued that we needed to send a loud and clear message by voting against continuation, by voting against some of the directors. And that has culminated in the last couple of weeks with a clear out of the board, the appointment of some new directors, notably the previous chairman of Roundhill, who obviously has a lot of experience within the sector. And as things stand at the moment, that those new directors are getting their feet under the table. They're conducting their own strategic review, I would say, understanding what's going on, and thinking what's best for shareholders. And we are giving them the time to carry that out for the time being.
Okay, thank you. Pershing Square next. Bill Blackman's been sort of quite vocal about he thinks the discount's too wide and he wants to do something about it. So why reduce it now?
Yeah, the discount is wide, and I would add to your question by saying that we actually like the underlying portfolio. And we think he's doing good things in terms of not only delivering performance, but also getting the message out there, by doing something different, particularly with the hedging portfolio, and by buying back shares as well. So the wide discount is a source of frustration to us, and it must be a source of frustration to him and the board as well. Rather like Exor, we took the view that we like everything about it. It is a wide discount, but the discount narrowing and any events around that would be more of a slow burn rather than more an immediate idiosyncratic event. And needing capital, we just tilted the portfolio away from those names, and it may come back to those names depending upon opportunity. But I would add also that in the case of Pershing specifically, whilst we have reduced the exposure to Pershing, we retain and have increased our exposure to one of their key underlying assets, and that is Universal Music Group, which we have a very constructive view on, and we have exposure to through a French holding company, Bolloré, which you see in the second column halfway down. And Bolloré there has got exposure to Universal Music directly, and also through the other French holding company, Vivendi. We think there are a lot of interesting things happening there. Bolloré has also sold assets, so we'll be sitting on a large amount of cash, and we expect him to be doing something in the foreseeable future around some of his portfolio holdings. So again, we've retained some of the exposure we have through Pershing. Universal makes up about a third of its NAV, and we've just diversified away into another source of potential return.
Great, thank you. We've covered a lot of ground on the portfolio, but we haven't talked about anything in Japan, and obviously that's a big chunk of it. So I don't want to sort of steal too much thunder because you're going to come back in a couple of weeks to talk about AVI Japan opportunity, but do you want to sort of say a little bit about what the attraction is here, please?
Yeah, so the attraction in Japan is twofold. Number one, there are lots of cheap companies in Japan. There are a lot of good companies in Japan that are growing their profits, generating free cash flow, paying attractive dividends, but are trading at very low valuations, both in absolute terms and when you compare them to where valuations are in the rest of the world. Coupled with that, the reason we've been so bullish about Japan is that for the last 5 or 6 years, Japan has been promoting a stronger corporate governance environment. And that's predominantly by way of the introduction of a corporate governance code and a stewardship code that has sought to pressurize companies to do more to deliver better shareholder returns, and at the same time has encouraged shareholders to engage much more with management, and for management to listen to what shareholders are saying. All of those things sound very obvious to us sitting here in London, but that wasn't the way in which businesses conducted themselves in Japan for the last few decades. And so the fact that you now have cheap valuations and you have a catalyst for unlocking those valuations is attractive, and it's why we've been so proactive in Japan. We see attractive valuations across the board. By that I mean through some large companies, but predominantly through small and mid-cap companies, which is where a lot of our exposure is. Over the last 12 months, it's fair to say that Japan has attracted a lot more interest from foreign investors. We've seen foreign capital flows increase into Japan quite sharply. We've also seen very strong performance from the main indices in Japan, and it's primarily been driven by large cap names. Large cap value has done very well in Japan. So our small cap names have lagged over the last 6 months. But there's clearly a sense that Japan, which for many years has been seen as an irrelevant market, a small weighting in the world index, and also a stock market that has been quite costly to investors for the last couple of decades. It hasn't paid off to be there. So for the first time, we're seeing shift in that attitude. We're seeing much more interest, confidence building around Japan. This time might be different, supported by a strong stock market performance, by an increasing number of investors being drawn there, and a sense that perhaps investors should take another look, and there's fear of perhaps them missing out on something.
Yeah, exactly. There's a lot of opportunity. Great, thank you. We've covered an awful lot of ground. As I said, we've gone through a lot of the portfolio. There's a specific question here about your dividend. So, what's the dividend policy? How does that work, please?
So the dividend policy is set by the board. The official line is that the board will try and maintain and grow the dividend each year. You see there that the last 4 years that's been maintained, it hasn't grown. And in a couple of those years, they've had to dip into the capital reserves in order to maintain that dividend. This year, there's been some strong income growth, and so that's been passed on to shareholders a small amount of that has been a special element that's unlikely to be repeated. So that's why it's broken out in that way. But the policy really, as I say, is just to, if possible, to maintain and grow the dividend year in, year out.
Great, fair enough. Thank you very much, then. I think we've, as I say, we've covered the whole thing. Thank you for your time this morning.
Thank you for having me.
And we'll be talking to you again in a couple of weeks, as I say, when you'll be back to talk about AVI Japan opportunity.
Okay.
So, thank you very much indeed. For everybody else, have a good weekend. Next week, Richard will be talking to Supermarket Income REIT. So have a good week, and we'll see you then. Bye-bye.
Thanks.